All right, let me ask you a question. If you stopped working tomorrow, how long could you pay your bills without stressing out? A week? A month? Or maybe not even that. See, most Americans live paycheck to paycheck. According to CNBC, nearly 61% of U.S. adults in 2024 said they don't have enough savings to cover 3 months of expenses. And yet there are people who don't rely on a paycheck at all. Their money is working for them every single month. Imagine logging into your bank account and boom, seeing fresh cash coming in without you lifting a finger. That's what we call monthly income investing. So today, I'm going to break down 5 proven ways to invest money to generate monthly income. These aren't get-rich-quick hacks. They're real, tested strategies people use right now in the US and worldwide to pay bills, build wealth, and even retire early. Stick around, because by the end, you'll have a clear plan on which income stream fits you best. Dividend stocks and ETFs. Let's start with the classic, dividend-paying stocks. When you own shares of a company like Coca-Cola, Johnson & Johnson, or Apple, you're not just betting the stock price goes up. Some of these companies share their profits with you, called dividends. For example, Coca-Cola has been paying dividends for over 60 consecutive years. That's through recessions, wars, and market crashes. Right now, its dividend yield is around 3% per year. That means if you invest $10,000, you'll earn roughly $300 annually just in cash dividends. But here's where it gets better. Instead of picking individual stocks, you can invest in dividend ETFs like Vanguard High Dividend Yield ETF, VYM, or Schwab US Dividend Equity ETF, SCHD. These ETFs hold dozens of dividend-paying companies, reducing your risk. Example, in 2024, SCHD paid about $2.64 per share in dividends. If you owned 500 shares, that's $1,320 per year, or about $110 per month just for holding. The risk? Stock prices can go up and down. Your dividend is fairly stable, but the value of your shares can drop in a bad market. That's why long-term, steady dividend payers, sometimes called dividend aristocrats, are safer bets. Takeaway: if you want long-term wealth and monthly income, dividend stocks or ETFs are your friend. They're perfect for people who can handle some ups and downs, but want consistent cash flow. U.S. Treasury bonds and corporate bonds. Now let's talk about bonds, the safer, more predictable cousin of stocks. When you buy a bond, you're basically lending money, either to the U.S. government or to a corporation. In return, they pay you interest, usually every month or quarter. And here's why 2025 is one of the best times in recent history for bonds. Interest rates are still relatively high compared to the past decade. U.S. Treasury bills, or T-bills right now, pay around 5% annual yield. Corporate bonds from solid companies like Microsoft or Johnson & Johnson often pay 5 to 6%. Example, if you put $20,000 in a Treasury bond at 5% yield, you'll earn $1,000 a year, or about $83 per month, risk-free, because Treasuries are backed by the U.S. government. For even easier access, you can buy bond ETFs like iShares iBoxx Investment Grade Corporate Bond ETF, or LQD, or Vanguard Total Bond Market ETF, BND. These funds automatically pay interest distributions, which can land in your account monthly. The risk? If interest rates fall, your older bonds look better, and you win. If interest rates rise, the market value of your bonds can drop. But if you hold until maturity, you still get your money back plus interest. Takeaway: bonds are like your financial seatbelt. They may not make you rich overnight, but they provide predictable monthly income, especially if you don't like roller coaster stock markets. Real estate investment trusts, or REITs. Now let's get into real estate without the headaches of tenants, toilets, or termites. A REIT, or a real estate investment trust, is like a stock that owns real estate. By law, REITs must pay out at least 90% of their profits as dividends. That's why they're one of the strongest monthly income machines. Popular ones include Realty Income, ticker O. They literally brand themselves as the monthly dividend company. Their current dividend yield is around 5%, paid every single month. Vanguard Real Estate ETF, VNQ, holds dozens of REITs with a yield around 4%. Example, if you invest $10,000 in realty income, you'd collect about $500 a year or $40 plus a month, like clockwork. The risk? REITs can be sensitive to interest rates. When borrowing costs rise, real estate companies feel the squeeze. But the upside is you don't need hundreds of thousands of dollars for a rental property, just a few $100 gets you in. Takeaway: if you want hands-off real estate income, REITs are the easiest way to start. Annuities, guaranteed monthly income. Here's something more traditional but very powerful in the US. Annuities. Think of annuities as insurance products that turn your money into a guaranteed monthly paycheck, often for life. For example, if a 60-year-old invests $100,000 into an immediate annuity, they could get around $500 to $600 per month for the rest of their life. This is why many retirees use annuities. They don't want to worry about stock markets or interest rates. They just want steady income, like a pension. The risk? Annuities aren't very flexible. Once you hand over the money, you can't easily take it back, and fees can be high depending on the type. That's why you need to shop carefully and stick to reputable insurance providers. Takeaway? If you crave certainty and guaranteed checks every month, annuities are one of the strongest income tools, especially for retirees. Last but not least, let's talk about the simplest income source: high-yield savings accounts and CDs. In 2025, banks like Ally, Marcus by Goldman Sachs, and Capital One are offering high-yield savings rates between 4 and 5% APY. That means if you park $10,000 in a high-yield savings account, you'll earn about $500 a year, or $40 a month without any risk. CDs, or certificates of deposit, are similar but lock up your money for a set time. In exchange, you might get slightly higher interest, like 5.2% for a 12-month CD. The risk? Very low, since most are FDIC insured up to $250,000. The trade-off is lower returns compared to stocks or REITs. Takeaway: if you want safe, predictable monthly income, especially for your emergency fund, high-yield savings and CDs are a no-brainer. Wrapping it all up, so let's recap. If you want to generate monthly income in the US or anywhere in the world, here are your 5 main options: dividend stocks and ETFs, steady cash plus long-term growth, treasuries and corporate bonds, safer, predictable interest income, REITs, real estate dividends without buying property, annuities, guaranteed lifetime monthly income, high-yield savings and CDs, safe, simple, and insured. Now, the big question is, which one should you choose? Here's my advice. Don't pick just one. Create a mix, maybe 40% in dividend ETFs, 30% in bonds, 20% in REITs, and 10% in savings accounts for liquidity, or adjust based on your risk tolerance. Remember, the goal isn't just to make money. It's to make money every single month while you sleep. Imagine this. You cover your rent or mortgage from dividends, your grocery bill from bond interest, and your car payment from REITs. That's how financial freedom starts, not with a lottery ticket, but with smart, steady investing. If this video opened your eyes, hit that like button. It tells me to make more content like this. And if you want to keep learning how to make your money work for you, subscribe right now and join our growing community. Thanks for watching. Until next time, keep investing smart and stay on your journey to financial freedom.